The IRS is now using artificial intelligence to analyze financial statements, and these algorithms can detect patterns and anomalies that human auditors would never catch, even in completely legal transactions. I'm talking about AI systems that compare your financial ratios against millions of other businesses, flagging outliers in seconds. If your numbers don't fit the pattern, you get flagged for audit. Here's the thing, having clean books isn't enough anymore. You need financial statements that make sense to algorithms, not just humans. Here's the reality. If you're watching this, you probably have a successful business with complex financials. Maybe you've been aggressive with deductions and you're worried about scrutiny. Or your margins look different from your competitors because you operate more efficiently. Or you think your accountant's work will protect you from any issues. Well, you're wrong for thinking you're safe. The AI doesn't care that your deductions are legal. It cares that they're unusual. It doesn't understand that you're more efficient. It sees anomalies, and your accountant probably has no idea how AI audit selection works. Most accounting firms, they're still preparing statements like it's 2010. They have no idea how AI analyzes patterns, what triggers algorithms, or how to structure statements to avoid false positives. The truth is, perfectly legal businesses are getting flagged for audits because their numbers don't match algorithmic expectations. And once you're in an audit, even if you're clean, it costs tens of thousands of dollars to prove it. At Numeratus, we're not just keeping up with AI, we're using it ourselves. We pre-audit your statements with the same tools the IRS uses, identifying and addressing issues before they become problems. If you've stayed on this video this long, it means you're worried about how AI might interpret your financials. You want to know what the algorithms are looking for. I can't guarantee you'll never be audited, but I can show you exactly how to structure your statements to avoid algorithmic red flags. And here's what's truly concerning. The AI doesn't just analyze your current year, it looks for patterns across multiple years, comparing changes in ratios, margins, and expenses against industry databases. One year might look fine to a human, but the AI sees trends and anomalies humans would never catch. So point number one, the ratio analysis trap. Tom was in his lawyer's office looking at a $50,000 legal bill. His crime? Being too efficient. 6 months earlier, Tom's SaaS company has been flagged by the IRS's new AI system. His gross margins were 70%, while the industry average was 40%. Tom wasn't committing fraud. He'd built incredible automation that eliminated most cost. He had 3 employees doing what competitors needed 20 to do. His efficiency was his competitive advantage. But the AI didn't care. It saw suspicious gross margins, abnormal salary expense, unusual tech spend patterns. Every efficiency looked like fraud to the algorithm. Audit took 6 months. Tom had to prove every transaction, explain every process, justify every efficiency. He won. He was completely clean, but it cost him $50,000 in professional fees and countless hours of stress. Here's what you can do. Restructure your statement presentation. Same numbers, but with detailed notes explaining the margin differential, industry standard categorization, and preemptive documentation of your advantages. Tom did this the next year. No flags. Same efficient business, just better presented for AI analysis. This is a fictional example, but businesses are getting flagged every day for being outliers. Do your financial ratios align with industry benchmarks? Most businesses have no idea how their ratios compare to industry standards until they're flagged. There's key ratios that AI analyzes: gross margin versus industry, operating expense ratios, employee costs per revenue dollar, the growth rate consistency. Being different isn't wrong, but it needs to be explained. The ratios are just the beginning. The AI also looks for impossible patterns. Point number 2, the consistency algorithm. Sarah's e-commerce business was growing fast. Revenue up 100% year over year. She was thrilled until the audit notice arrived. The AI had flagged something it thought was impossible. Her revenue doubled, but her merchant processing fees only increased 20%. To the algorithm, this meant hidden cash sales, unreported income, or just downright fraud. The reality: Sarah had negotiated better processing rates as her volume grew. She switched processors mid-year for better terms. Completely legitimate, but the AI didn't know that. The algorithm looks for these impossible patterns. Revenue growing faster than variable cost. Margins improving without explanation. Expenses dropping without operational changes. Inconsistent relationships between related accounts. Sarah spent 3 months proving she wasn't hiding cash sales. Every transaction had to be verified. Every processor change documented. This is fictional again, but the consistency algorithm is real in catching businesses daily. Are your financial statements telling a consistent story across all the line items? Most businesses focus on bottom line numbers without ensuring all the supporting details make logical sense to an algorithm. What AI checks for is consistency, inter-account correlations, margin progression logic, fixed cost stability patterns, and revenue to variable cost relationships. Every line item needs to tell part of a consistent story. Now there's a way to protect yourself from AI false positives, and that's point number 3, the AI proof documentation framework. Michael learned about AI auditing the smart way before he got flagged. His manufacturing business had several anomalies, higher margins than competitors from vertical integration, lower employee cost from automation, unusual inventory patterns from just in-time manufacturing. Instead of waiting to explain in an audit, here's what you can do. Create algorithm annotations, preemptive documentation designed for AI analysis. Every unusual ratio gets a note explaining why. Every significant change gets documented. Every industry deviation gets justified with specific business model explanations. When the IRS AI scans your returns, it sees the flags, but also sees the explanations. The algorithm moves on to easier targets. Michael's competitors, with similar anomalies but no documentation, 3 of them got audited last year. This is, of course, once again fictional, but preemptive AI documentation is a real strategy that works. Do you have documentation that specifically addresses algorithmic concerns? Most businesses have basic documentation that doesn't address the patterns AI systems detect. AI proof documentation framework is ratio deviation explanations, year-over-year change narratives, business model clarifications, industry difference justifications. The key is explaining your anomalies before they become audit triggers. Look, AI financial analysis isn't coming. It's here. The IRS, banks, and investors are all using algorithms to analyze your statements. You can't hide from it, but you can prepare for it. Every financial statement you file is being analyzed by AI. Every anomaly is being flagged. And if you can't explain your patterns, you're headed for an expensive audit. If you want AI resilient financial statements, if you want to understand what algorithms are looking for, and if you want to maintain aggressive tax positions without triggering audits, you need specialized expertise. At Numeratus, we use AI to protect you from AI. We analyze your statements with the same tools the IRS uses, identifying and addressing issues before they become problems. Visit numeratus.us to learn how we're using artificial intelligence to protect our clients from artificial intelligence. Because in the age of algorithmic enforcement, traditional accounting isn't enough. And if you don't believe me, just wait for the letter in the mail.